Are you a losing trader and you're looking to become a consistently profitable trader with a proven profitable trading strategy? If that's you, then this video is for you. Because in this video, I'm going to be revealing the step-by-step trading strategy blueprint that can get you to $10,000 a month from trading. This is a 4-part series. In the first part of the video, I'm going to be walking you through how to form a directional bias. This means how to understand where the market is going to go next. In step number 2 of this video, I'm going to be showing you key areas of the market where smart money are actively involved and are protecting that area. And then in step number 3, I'm going to be sharing with you the trading strategy blueprint. And finally, in step number 4, we're going to take that blueprint and go and back test it in the live market. So in step number 1, we're going to be identifying how to form a directional bias. Now, what we can see on this left-hand side, we have bullish market structure. It's bullish because it's putting in a series of higher lows, higher highs, higher lows, and higher highs. What we can see is that the external swing points, right, referred to as our swing points of market structure, are gradually getting higher and higher. This indicates that smart money has a vested interest in taking price higher. So what we see after every break of structure, we have a pullback. So in this scenario right here, we've just had a bullish break of structure. What would you be expecting to happen next? You'd be expecting for price to pull back and then continue trading higher. That is the whole purpose of this bullish market structure. And our job as traders would be to identify our trading opportunity to go long in this area exactly right here. Because before price even gets here, we already know that price is bullish. So we're going to wait for price to pull back into an institutional area, which we're going to look at in step 2. And then we're going to look for our signs that price is now ready to go higher, and we're going to get involved in this up move in here up to this high. So our value discrepancy, our edge, our trading strategy is dependent upon knowing where price is going to go and where we can get involved in relation to that price movement. In this bullish example, we can see that price is bullish. We know where it's going higher. So we're waiting for price to come back like this, and then we're going to get our signs from our institutional levels to trade higher, and we're going to catch the move from in here to up here. That is our value discrepancy, right? So if we look on the right side, it's a little bit more of a realistic approach to what market structure looks like on the actual charts themselves. You can again see we have our swing low, we have our swing high, we have our higher low, higher high, and then you can see that price is having this internal pullback. Now, a lot of people will make the mistake in thinking that for some reason now we are officially bearish because price is putting in these lower lows, like that. But the reality is that price is bullish inside of the constraints of this low and this high. And so what you can do is you can draw a box from your swing low up to your swing high, and you can pull it across. And what you can do is you can say that anything inside of this box until we've broken out to the upside is internal. Therefore, we're not going to try to judge this price action as bearish when we see that it's trading lower. This is expected. What we're waiting for is to pair that with an institutional level at this low that's already respected and then trade higher. So we want to get involved in an area like this, and we want to trade long into this high right here. And again, the mistake that traders make is they see that price is making these lower points inside, and then they try to short the market, when in reality they're just going to get stopped out because they're looking on the wrong side of the market, which is most traders' mistake. So with that being said, you can see that our internal pushes lower like this, then we have this, and then we trade as expected higher. Once we actually break out of that trading range, we form a new trading range. Now we have a swing low and a swing high again. This is obviously our higher high. The question is what is our higher low? Is it this low or is it this low? Again, another huge mistake that traders make is they will think that this is the low that is now in control of the market, when it's not. The swing low is this because we are looking for the furthest point that price pulled back before breaking structure. And the system that you can use to identify this level is the box that you've drawn. When price breaks out of this range, you can go to that box and you can ask yourself the question, where is the lowest point that price has pulled back before we broke structure? And you can look and you can go, well, is this the low? No, because we made a new low. Is this the low? No, because we made a new low. Is this the low? Yes, because this is the lowest point that price reached before breaking structure. And so now you have your swing low and you have your swing high. You've just had a break of structure, so let me ask you the question. What are you expecting next? The answer is you're expecting some kind of pullback, again, into an institutional level before trading higher. So we already know that if price is bullish right now, which it is, we want to be longing. And we want to be longing from somewhere inside of here because we want to see something like this to go here, right? So that is more than likely what will happen. Price will have this pullback like this, and a lot of traders will get caught because they will think that this is their swing low. They'll see that that level gets broken, and now all of a sudden they're trying to short, when in reality, price is getting ready to trade higher, right? Because again, this is our swing low, this is our swing high. We're expecting price to respect this low, and we're expecting price to target this high. And that is exactly what happens. And what we can read again, if we just draw our low to our high and pull it out, is all of this inside of here, right? Anything inside of this box, it's all internal. So again, the same mistake that traders are making is they're seeing these little lower lows, lower highs, and thinking that price is bearish. And that is why people continually get caught on the wrong side of the market. What you need to wait for is something like this, where price is putting in these internal lower lows, and then price shifts from lower lows to higher highs, meaning this high is higher than the previous high. That is your telltale sign that price is now ready to go and target the high that we are waiting for. And that is our opportunity to get involved in a long position from here and ride it up to here. Now moving on to a bearish scenario. But in this scenario, I'm also going to add in a reversal. So pay close attention. The first one, which is the basic one, we're going to be looking at, again, nothing new. We have a high, we have the low. That is our current trading range. Price pulls up, puts in a lower high, meaning this high is lower than the previous high, and then puts in a lower low, break of structure. So now it's confirmed that smart money have the intention to trade lower. So we get a lower low, a lower high, a lower low, a lower high, and a lower low. Those are the bearish price moves. And every time that we get a break of structure, what we want to be doing is identifying an area of institutional level that's inside of this high to this low, price to pull back into, and we can short into this low down here. And then again, break of structure, identify an institutional level, price pulls back into that area, and then you can short. And at some point in time, smart money will have exhausted their resources to the downside. So what will happen? The trend will shift from bearish to bullish. And how do we get that? Well, we have a break of structure to the downside, so price is bearish, and then we have a break of structure to the upside, right? Meaning that we were going from lower lows, lower highs, and lower lows to higher highs, right? And that is considered a change of character. Now, change of character, think about it for a second. We have two characters inside the market at any one given time. We have a bull and we have a bear. Bullish, meaning price is trading higher, and bearish, meaning price is trading lower. When you go from bearish being in control, so lower lows, lower highs, and then you get a higher high, which is bullish, you have changed character. Your two characters have shifted between each other. That's all that means. It's simply just a trend shift, a reversal. So at this moment in time, we have just shifted from lower lows to lower highs, meaning what? We've shifted from bearish to bullish. So no longer are we looking at short positions. Now we're looking at long positions. And so what would you be expecting? A pullback into this level before continuation higher. And where we get involved, we're waiting for this pullback, waiting for our confirmation, and then we're getting in on the long positions. And it's that simple. And that is why market structure is our most important component when it comes to our trading strategy. Now let's take a look at a little bit more of an advanced version of this. Again, same thing. We have a high, we have a low. That is our trading range. Price pulls back, lower high, lower low, trading range. Okay, stop. take the low, take the high, pull out. Anything inside of this box is your internal. Don't get lost in trying to long the market when you see this happening, because you know that overall we're expecting lower prices. You are only interested in shorting when it makes sense. So when price pulls back like this and then breaks structure, giving you a lower low, that was obviously expected. Now, where is your lower high? Now, we look at the highest point that price pulled back before breaking structure, which is here. That becomes a high. This low becomes our low. Price pulls back, breaks structure, and then what? Changes character. So we've changed character again now in the reversal from bearish to bullish. So what would we be looking at now? We'd be looking at long in the market. But remember, we are interested and we know that this right here is the low and this right here is the high. Don't get lost in thinking that this is the high or this is the low, because if price pulls back, like it does a lot of the time, like this, a lot of people will think that price has shifted bearish now, but it hasn't, because the low is here and this is the low that's going to be respected. So then when price shoots back up, most people other than me and you are going to be getting caught on the other side of the market. Key important information. So with that being said, let's move on in to step number 2, which is how to actually identify areas where smart money are actively involved using specific volume-based candles, right? So what we can see is step number 1, we need to identify our bias. Are we bullish? Are we bearish? Are we expecting price to trade higher, to trade lower? Let's have a look. We have a high in here, we have a low in here. Price pulls back and then goes lower low. So, okay, at this moment in time, we are bearish, so we'd only be looking for short positions. Then you can see that price pulls back like this, right? Price pulls back, then it begins to range a little bit. So this range here indicates potentially volume is dropping off. Price may be getting ready to go short. A lot of people will be getting involved in here early and looking to short. But what smart money will do is they will manipulate price. This is why you see a lot of the times retail traders getting their stop losses manipulated when they see things like equal highs or double highs or resistance in place. That will often get broken through purposefully just before reversing and continuing in the area that they wanted to go in anyway. Why is that? Let's take a look at that. So essentially what we have here is liquidity. This is a lot of people's stop losses. And in this area, the stop losses, when those stop losses get hit, they actually get triggered as buy positions, right? They're buying back their positions. So what smart money will do, if they want to trade lower, they will first trade higher. And they will do that because they will manipulate price to try to manipulate people to think that price is going to trade higher. So they buy. Now that buy liquidity enables them to take the opposite side of that trade and sell, right? But because smart money are smart money, because they're large money, they're institutions, banks, etc., they have such a large amount of money that they will move the market drastically if they can fill all of their positions. So what they do, they manipulate people into going the other way so that they can use that liquidity to position their orders at that level. Because if there's no buyers in the market and they sell, price will drop drastically and they will not get a great fill on their price. But if they can get people to buy first and then they can buy all of those orders, take the other side, the sell, they can average their prices a lot better. So that when price goes eventually, they're then able to average their positions in this level, allowing them to make more money. That's what you'll see a lot of the time. And this is what this schematic is. We can see we have a range in here that creates liquidity. And then we can see that we get the aggressive buy, taking that liquidity out, and then an aggressive sell candle. That is how you can identify the footprint of smart money. And it's going to look exactly like this from a candle perspective. You'll have this bullish candle followed by this bearish engulfing candle. And then you'll have some sort of break of structure. Now, here's where things get interesting. Smart money have initiated their sell positions in this area. So therefore, if they want to see price going lower, and we're bearish, so they do, and they've initiated some of their sell orders inside of this level, do you think that they would allow or they would take price above that level? Well, no, because the moment that price gets above this level, they are now running in negative equity. And obviously they're not going to lose money, right? So you will see a lot of the time, this area, and this is where it gets the word order block from, this area will be blocked. Buyers in this scenario can't get through this level. So buyers will try to get through the level and they won't be able to, because it will be met with such a strong amount of sell orders, because smart money have positioned themselves in this area of price. So this acts as almost like a barricade for price. Price can't any longer get involved and get past that level. So this level will hold, and as expected anyway, price will continue in its structural nature. So this alone does nothing. But when you pair it with market structure, it does everything. We have a bearish market structure, lower lows, lower highs. Price comes up, smart money manipulation, smart money initiation, break of structure. We're already expecting that price is going to trade lower. And now we're pairing that ideology with a smart money order block, an area of price that they are protecting. So when price gets back in there, a remaining amount of their orders will get triggered and price will sell off. That's what you'd be expecting to happen. And where would you be looking to target? You'd be looking to target, obviously, just the next low. The next low is fine. And there is your value discrepancy. You are bearish before we get here, and then we get here, and now you're already bearish, so you're looking to short. You can get involved, for example, in an area like this. You can put your stops above because it's a protected area. And then you can target the lows down in this level. That is pretty much how we're combining order blocks and market structure with a little bit of liquidity concepts. So again, we're going to run over another example, but this time just using a bullish scenario, right? As we can see, price is low, we have a high. So there's our trading range, right? Now price has a pullback, lower high, higher low, higher high. So we have a break of structure that confirms that we are bullish. Break of structure higher, price then begins to pull back to this level. And remember, because we know that we are bullish, right? And that this low is going to be respected and this high is going to be targeted, we, unlike a lot of other people, aren't trying to short the market when we see this internal price delivery, right? A lot of people are trying to short the market in here. And then again, once again, price comes into this type of range area or building of some sort of liquidity, and then smart money will step in with some sort of manipulation, which is this sell into a buy. So they can take out these stops in here and they can get a better average of their price in this level. And that is what you're seeing when you see this exact schematic. And so that is what you would be looking at. There is your identification of smart money. That leads to a break of structure, right? A break of structure to the upside. And then what are we looking at from there? We're going to be waiting patiently for price to make a pullback into this level. And then that is the level that we are going to be looking to buy from, because we know that this level is protected. And we know that because price is bullish, the likelihood is that price is going to trade higher. The probability indicates that price will trade higher. So from a level like that, you'd be expecting a reaction like that. Now, the reality is this going to work every single time? No, obviously not. But trading isn't about being right every time. Trading is about understanding your profit expectancy, which is essentially how many trades you win and how much you win when you win and how much you lose when you lose. And so even if you take 10 trades and you win 5 of them, and on the 5 trades that you win 3 times your risk. And on the 5 trades you lose your risk. So 1 each time. Well, let's run the math. You've taken 5 trades, 5 losers, minus 5%. You've taken another 5 trades, 5 winners, and each win represents 3% in profit. So you have a total of 15%. So now you've got 15% in winners and 5% in losers. Subtract them, and you're left with a net 10% profit. That is ultimately the formula to profitable trading. So let's go ahead and get into the next step. Step number 3, and probably one of my favorite ones. This is going to be our trading strategy blueprint. So essentially what you can see here just before we get into that is anything that's represented in a full black line is going to represent the 30-minute time frame or the 15-minute time frame in some scenarios. And then anything that is dashed like this is going to represent the 1-minute time frame. So what we see is price is on the 30-minute time frame making a series of higher highs, higher lows, right? We are bullish. Step number 1 is identify your bias. Are you bullish or are you bearish? Okay, cool. So at this moment in time, we are bullish. We are expecting price to trade higher. And then we're going to be expecting some sort of pullback. So you can see that price break structure begins to pull back into some sort of institutional area as always. And then price will do something like this. Again, we will probably build some sort of liquidity in that area. And then we will have some sort of manipulation. So a sell into this liquidity pool before the aggressive move, the real move out of the market. And then we're going to lead to a break of structure. So what we have right here, and the two most important steps, is number one, we are bullish. Our bias is long, right? We have a swing low down here because we've just broken structure, and we have a swing high up here, which is expected to break structure. Okay, that's the key. Now, we have our bias, we're bullish, we're looking to long. We have our area of interest, which is this sell to buy candle, and we're going to map out the selling portion of that candle as our point of interest, right? Because that is the area where smart money have actively manipulated price, right? They've sold so that they could trigger stop losses, trigger more sellers to average better buy positions. When price comes back, it's called the process of mitigation. They're now going to be able to close those sell orders at a break-even level whilst they close simultaneously some of their buy orders in a profit. That's essentially the process of making money. So from there on out, we have a bullish bias. We're expecting longs. We're going to wait patiently. A lot of traders, unfortunately, breakout traders and things of that nature, what they'll be doing is they'll be buying this break of structure. And they'll probably have their stop loss some area inside of the actual price leg itself. And again, nonetheless, no surprise, price pulls back. A lot of breakout traders often end up failing traders because they're trying to buy too early. Our whole objective is wait for break of structure, then wait for pullback, because pullback is going to happen. It's the natural balance of the market. So when price pulls back, and when and only when we get into our institutional smart money area, then I want to drop down to a 1 minute time frame. When we drop down to that 1 minute time frame, the likelihood is that when price is pulling down on that 1 minute time frame, we are going to be bearish, right? That's as simple as it is. We're going to be bearish. And so the 1 minute time frame will look something like this. We'll have a bearish price action where we'll get a break of structure. But when we get into this level, because we're expecting that overall price should react from this level and trade higher, the 1 minute will react before anything, right? So when we get this break of structure bearish on the 1 minute, then we get a change of character. Now what we have is the 1 minute time frame has just aligned itself with the higher time frame. So we have a bullish 30 minute and a bullish 1 minute, and now we're ready to go and target this next expected break of structure. And it's the same schematic. Once you get that change of character on the 1 minute time frame, you're identifying this exact same smart money level on the 1 minute time frame because it exists all around. And then we're going to be looking at buying from this level, stop loss under the low, and targeting the high. The reason that we drop down to the 1 minute time frame is to increase our risk to reward ratio, because the stop loss is going to be much, much lower, and therefore the take profit much, much higher, and the risk to reward multiple is going to be a lot higher, typically a minimum of a 1 to 5, meaning if I risk $1,000 on this one trade, I will make $5,000. And that way, if I take two trades and one is a loser and one is a winner, I lost $1,000, I made $5,000, right? I have a 50% win rate. I lose, I win. It's normal. But because of my risk management, I made $4,000, even though I didn't win any more trades than I lost. That is the power of risk management, right? So that is what we'll be looking at. And then we'll be looking at price to take out this level in here. So now let's go and take this exact strategy, this exact blueprint, and go and apply it to the live market, which is probably what you've all been waiting for. So here we are on GU, right? GBP USD on the 30-minute time frame. So what we want to do is we want to replicate the exact same system, the exact same strategy from before onto this market. So how do we do that? Step number one is we are going to identify our directional bias. So we need to get a read on market structure. So what we can see right here, we had this aggressive push down, right, which likely indicated that we were bearish. We have a swing low, we have a swing high, right? then what do we have? If we map out this swing low, and again, remember, ignore all of these little moves inside. Let's use our box strategy, right? We're going to take the box from the low to the high, right? And we can draw it to here, and then we can pull it across until price breaks, right? Just like that. And then eventually we will get our break of structure. Break of structure to the downside. Now, on this break of structure, we have identified that price is bearish, right? We are expecting lower prices. From there on out, once price breaks structure, this becomes our lower low, right? This is the lowest point that price stopped at before breaking structure. From then on out, although it may be small, it's still a pullback. Price it meets our golden pullback rule, that it pulls back up into this level and then again goes lower low. Another break of structure, right? Break of structure to the downside, which then means what? And again, I know it's very tight, but again, we have a system rule-based approach to this. This is our swing high. This is our swing low. So you may be expecting that price would likely trade higher, but actually it trades high. You may be expecting that price will trade lower, but actually it trades higher. And it gives us a change of character, right? This is the process where price goes from lower lows, lower highs, lower lows to higher highs. So again, we have a higher high. We have a change of character. Now we are bullish. You'd be expecting price to trade higher. In this exact scenario right here, we actually end up getting a wick of this low. Now, it's important to note that a wick and a body close are two very, very different things. A wick indicates liquidation. Body close indicates break of structure. So we don't include wicks as our structural points, right? Very important denomination, because price wants to run on these stop losses so that it can trade higher. Now, from there, we are bullish. We're expecting higher prices. And then what do we get? We get, this is the low, and then we get this high gets broken, right? Break of structure as expected. So now we can identify it as this low down here to this high up in here. That is our current structure. So again, we can draw across the low right here, and we can draw across the high up here. So this right here is going to be our expected target, because we're expecting a break of structure, just another continuation. This low right here is our protected low. Why? Because price is now bullish, therefore it's going to continue likely trading higher, right? That is as simple as it is. Now I'm going to turn on this session time indicator, because this is going to show us what times that we're looking at. So this blue box right here represents the Asia session. And anybody who understands the Asia session knows that it has liquidity on the buy side and liquidity on the sell side. And so remember what I was talking about. When smart money steps in and they want to buy, before they buy, they will sell into liquidity. If we look at the previous day, so if we look at Tuesday's price action, we had Asia right here. What did they do? They sold into Asia low and then brought price higher. The exact same thing happens the next day, and it's something that happens continuously. We see Frankfurt sells into an aggressive buy. So it's the exact order block that we were looking at when we looked at the theoretical framework. It's a sell into a pool of liquidity, right? Liquidity being all of these lows in here, this little range in here, that is our liquidity. So we sell into that liquidity and then we aggressively buy out of that level. So this area right here represents our order block, right? So we'll note it as our OB and we'll put it in the middle. This is representative of our order block. So now I can turn my session indicator off. At this moment in time, it's 8 a.m. New York sessions. It's a New York setup, right? So we have step one, our directional bias. We're bullish. We are literally expecting price to trade higher. Step number two, we have our institutional area of price that we expect to be respected, which is this final sell to buy that broke structure, right? Now, if you remember, step number three is patiently waiting for price to return to this level, just like this, right? So let's wait. See if we play candle by candle. So price eventually gets into this level. Now, when price gets into this level, what do we do? Remember, we then drop to the 1 minute time frame. So I'm now going to drop in here to our 1 minute time frame. Now, our key here is we need to identify the actual direction for price. So what can we see? We can see that price puts in lower low, right? We can identify that this is a high, this is a low, price comes back up, respects the high, breaks the low, right? Break of structure. So we are bearish very clearly. And as I said, we're bullish on the 30-minute time frame. But if we just zoom out for a second, our 30-minute time frame, the low of the 30-minute time frame is down here and the high is right here. So obviously when the 1 minute time frame is coming back, it's going to be bearish when it gets here. That is just how the market operates. So if we zoom in and understand the most recent price action is the most important, we can see that we have price pulls back, we have lower low, lower high, lower low, lower high, and lower low, right? So price is obviously printing bearish structure. So what we want to do is we want to zoom in. Now, the key is we only drop to the time frame when we get inside of this gray box. And what we're looking for is some sort of push in, push out, push lower, and then shift higher. So what do we get? We get a push into this level, we get a push out of this level, and then we get a liquidation of this low. Albeit very minimal, it is a run of this low down here, right? This is the market structure shift entry model. And then we get a liquidation of this low right here. And then we get a run with a break and close of the high that caused the low to be placed. And then what are we looking for? Same thing again. We're looking at the final sell candle before the aggressive buy comes in that actually runs on some liquidity, which is this low in here or this low across here, right? We're looking at this sell before we buy. That is going to be the area that we can look at taking this position. And essentially what you can do is you can initiate your long position at the highs, your stops at the lows. That's a 3.5 pip stop loss. And where are you going to target? Well, we're expecting that price is going to reach for our expected target up in this high area in here. So we would look at this being our take profit, 15 risk reward. However, personally, in full transparency, I have a profit management system where I will take 50% of my trade off at 5 risk to reward first. And the reason that I do that is because sometimes you may not be right in the direction, but you may get the reaction. And sometimes you may see where price will come in to your level like this after backtesting hundreds, if not thousands of trades and tracking all of the data. You understand that sometimes price will run into here like this, will trade up into here, and then it may be time for price to reverse and it will do something like this. And to watch your profits be up thousands of dollars to then watch it come all the way back down and get stopped out for break even is a depressing thing. So after collecting all the data, what I found is that a lot of trades first ran to 5 risk to reward before they reversed. And some trades ran for full volume. But it's about understanding what's the best balance, right? So I have a fixed take profit 1 of 5 risk to reward, which is this to this. And then my second take profit, so take profit number 1 is going to lock me in 5R. And then my next take profit will be the 15-minute or the 30-minute swing high, which will be up here, right? That is my take profit system. Now, here's another thing. This trade right here could end up stopping me out and then giving me another chance to enter. And if I was to take the second entry, and the second entry was a profitable one, taking me 5 risk to reward, even if it was 5 maximum, I lost 1 trade, so I lost 1%, and I won 1 trade and made 5. And so I'm net 4R, even though I just lost a trade and just won a trade, right? It's all about your profit management. It's all about your trade management and your risk management. So with that being said, how did this trade and how did this system play out in the live market? So price eventually pulls back into this area. And again, what are we doing in this range right here? We are just building areas of liquidity, right? And again, continue trading lower. run on the liquidity. We failed to take out the high, no break of structure. We created more liquidity across the highs. Price tags in to the position, aggressive move out, pulls back to respect it. And then price, have we hit take profit 1 yet? Nope. So again, break even at this point. So I would remove my risk off the trade. And I'll just be waiting for my first take profit to hit, which is this right here. That's 5R. I would close half of the position, so 2.5. And if you, let's just say, for example, you had a $100,000 funded account, which is a very easily attainable account. We have multiple traders in our community that have $700,000 in funding, $900,000 in funding, $300,000 in funding, $200,000 in funding. $100,000 in funding is very, very attainable. So if you had $100,000, which is where everybody pretty much starts, and you risk 1%, your first take profit level was $2,500. And your second take profit level, being as 15 risk to reward, with half of the position, is going to be 7.5%, which is $7,500. So if this hits this second take profit, this and this together would be $10,000 in a single trade. So let's continue playing price out to see how it plays out. So price is just continually, as you can see, abiding by structure. Price pulls back, changes character on the 1 minute time frame, continues ranging. Again, going to speed it up on the 5 minute time frame. So just drop it into the 5 minute time frame to speed things up. You can see the end result, how price played out. And eventually price hits the full expected target for 15 risk to reward. So a net profit of 10 risk to reward on a $100,000 account, risking 1% is $10,000 in a single trade. And if we just recap just for a second, the 30 minute time frame, that was expected, right? It wasn't luck, it wasn't random, it was completely expected. We were bullish, we had a pullback, we just wanted to trade the continuation. We use our lower time frame entry model to get in an area that institutions have already protected. We fix take profit at 5R. Our second profit is where we're expecting price to head on a structural level.